Today's presentation is going to be on the top 5 market moving events. And as I mentioned just briefly, there's so many event risks that we get on a week-by-week basis. My focus here is going to be just on 5 general topics and areas that we typically see and that has pretty much a great influence on price action. And again, as I mentioned before, fundamentals is one of the main areas that I like to focus on. That's really what got me into trading currencies. And I've been using this example quite a lot, and actually this is how I look at fundamentals versus technicals. For those of you that are familiar with my work and a lot of my research, I like to incorporate both. And really the way I like to use fundamentals, it gives me a general direction of where I want to go. So being that we are in Las Vegas, Nevada, for me to get back home, as far as I know, I got to go back east. How to get there? That's essentially what technicals show me, are the short-term timing. So essentially where I have to get on the ramp, which ramp I should get on, which highway I should take, for how long. But again, fundamentals are more of the general sense of where we got to go. And again, I use fundamentals in my training all the time. And the reason why I love fundamentals is because it's very basic, it's very simple, and the concepts are very solid. The one belief that I have is essentially with currencies, the strength of the economy should reflect the strength of the currency, and that's on my basis of really why I like to use fundamentals. But before we get any further, quick risk disclaimer here, and of course, like trading any financial product, trading foreign currencies entails a lot of risk, and I'm sure all you guys have been seeing this risk disclaimer all day, so we'll go through it relatively quickly. But again, because FX involves a lot of leverage, acts as a double-edged sword, so please do your homework and please be aware of the risk entailed. And of course, past performance is not indicative of future performance. So I really encourage everyone to know what they're doing before they jump in. But getting straight on with the presentation for today, again, fundamental analysis. Fundamental analysis, it really helps me to determine the direction of a currency's value. As I mentioned before, the underlying strength of economy should be reflected in the exchange rate. And this is why I really like to use fundamental analysis in my everyday trading. So, based on this, what do we like to really do is focus on key underlying economic and political factors that really help us to gauge how the economy should perform going forward. Again, we're looking into the future and we're trying to project where the currency is going. And a lot of these developments that we get coming out of the economy should give us a good gauge on what to expect going forward. Beyond that, we want to answer key questions, or really the fundamentals help us to answer key questions regarding current events that's happening. And I'm sure for those of you that flew into Vegas over the weekend, there was a lot of developments coming out over the weekend, especially on Friday, really involving Europe. And even today, we see some more data coming out and really a lot of news, current events that have started to impact the currency market. So fundamental analysis, why is it helpful? And again, we have tremendous amount of questions that in regards to when we take a look at what to expect in terms of the exchange rate, fundamentals help us to answer a lot of questions. So one question it really helps us to understand is what are central bankers most concerned with? So going back to my college days, one thing I never really fully understood as I was studying was why is it so important what the Federal Reserve says and what they expect to see in terms of the economic activity. Another question I always used to ask myself is the economy expanding rapidly or contracting? And again, a lot of these fundamental analysis can help us to really get a better gauge of what to expect going forward, and it really helps us to answer a lot of these questions here. Beyond that, we also get to the question of what parts of the economy are about to boom or about to bust. And this is very important because the makeup of each different economy is very different, and we want to look at the underlying strength versus the underlying weakness of each economy. Beyond that, we want to know, are new jobs being created? Why? Because jobs are very important for any economy here. Again, the economy is made up of people. People need jobs to make money, and that's really what helps to stimulate the economy. So these are some of the major questions that fundamental analysis helps us to answer. At the same time, what we also want to know is, in terms of prices, are prices stagnant or rising too fast? Why? Because although we see the economy rising and we see growth really being robust, the question is, how are prices reacting to that? And in terms of purchasing power, are basically the citizens Are they able to afford more things because of this growth, or are we seeing rising prices that are really dampening economic activity? And I'll definitely get into some examples of that here. So we'll first start off with, as I mentioned before, my main focus is the Federal Open Market Committee interest rate decision. So we'll go over that first. Secondly will be the growth rate, which is also considered GDP. Beyond that, we'll go into private sector consumption, we'll go into employment, and then we'll certainly leave off with inflation. So these are the 5 major categories we'll be going over today. So starting off with the Federal Open Market Committee interest rate decision. So the Federal Reserve gets its power from the Federal Reserve Act of 1913. And in this act, they were actually empowered with these 3 powerful tools. First one being the federal funds rate, next one being the open market operations, followed by the reserve requirements for commercial banks. And again, these are the 3 main tools that the Federal Reserve uses to really balance the risk for the economy and really to follow out with their mandate. So beyond this, the biggest one that everyone looks at, again, is the federal funds rate. And the reason why this is so important, and the reason why everyone looks at what the Fed plans to do with this federal funds rate, is it's basically the interest rate banks charge other banks to borrow money. So in essence, it's basically the rate that commercial banks can borrow from one another. And why is this rating so important? And it's typically because we see these interest rates affect foreign exchange rates, short and long-term interest rates, as well as the supply of money and credit. And at the same time, it really has an effect on economic variables such as employment, output, and prices of goods and services. So, getting on with the central bank here. What is the Fed's central bank mandate? Again, we want to know what the Fed needs to do, what is their job, and how are they using these tools to really just complete their mandate. So, the Fed really has 2 primary mandates here. So, first one being price stability. What price stability really is a precondition for maximum sustainable output growth and employment. And I'm sure all of you have heard of price stability or maybe even inflation. And for those of you, and to really take a real life example, when I'm back home, I actually have a car, and when I do see, recently when I saw gas prices hit over $4 a gallon, that really took a toll on my disposable income. In essence, because I needed to fill out my car, that really got me thinking of maybe I should spend less on something else because I needed to put gas in my car. And really, this is one of the things that the central bank, they try to get at, really preserving price stability because they want prices to really remain stable so it doesn't really take a too big impact on basically the consumers. Beyond this, another mandate of the Fed, the second primary mandate, is full employment. Essentially, we want full employment in order to promote long-term growth. Again, the economy is made up of people just like me and you, and one thing about the U.S. economy is actually private sector consumption is really one of the leading drivers of growth in our economy, and that's why we need jobs, we need people to spend money to really help stimulate our economy. Beyond that, the Fed's funds rate. So essentially, what the Fed tries to do with the federal funds rate is they try to balance their dual mandate. So in essence, what do we get here? Because they move the federal funds interest rate to balance the risk for the economy, essentially, at times, they look to raise the benchmark interest rate. Why? Because they want to combat high inflation and slow growth. So what does that mean? When we're looking at higher interest rates, it basically increases the yield and it actually lowers the money supply. So in terms of that, what does that do to the US dollar? It actually raises demand for the US dollar because, again, we have a lower supply of dollars, but at the same time, yields or basically borrowing costs increase. So when we're going to the bank to borrow money, when we do have a rate hike from the central bank, it raises the cost of borrowing for each individual. But vice versa, when we get a rate cut, we see the central bank do so to really stimulate growth and to really bring up inflation. And what it really does, on the other hand, when we take a look at the slide here, it reduces the yield and it also increases the money supply, thereby dampening the appeal for the US dollar. So taking that example here, when we do see an increased supply of US dollars, because there's more dollars in the market, there's less demands for it, and really as we do see borrowing costs start to fall down and it's cheaper for businesses as well as households to borrow money, we see really these effects stimulating the economy when we do get a rate cut from the Federal Reserve. So here we have a chart of the FOMC interest rate decision. Basically, the blue line here that we have is the federal interest rate decision, and this is the actual interest rate decision that we have here, dating all the way back in 2001. The green line that we have there is actually the U.S. gross domestic product, which is actually the growth rate. And beyond that, with the red line, what we have is the U.S. Consumer Price Index, and we'll go further into that later on in this presentation, which really is a gauge for inflation. So again, it might be a little bit confusing taking a look at this chart here, but I'll break it down for everyone so it's very clear on what I mean. So keep a close eye on the red and the green lines there. So we have growth and inflation. During pretty much the beginning of 2001, we saw growth and inflation slowly increasing. Although, when we look at what the Federal Reserve did, they were actually cutting interest rates to stimulate that growth. So what happens with growth and inflation as we see time progress going into 2002 to 2003 when, again, interest rates were slowly coming down, we see a slight upward trend in growth and inflation. So what happens when growth and inflation gets too high? We actually see the Federal Reserve reverse what they were doing, and now we see, again, the blue line, which is the federal benchmark, which is the federal funds rate, we see that slowly starting to climb up because, again, the Fed thought growth and inflation was getting too high. They wanted to slow it down a little bit, really just balancing, again, a balancing act here between growth and inflation, and ultimately we see that exchange rate climb all the way above 5%, really coming into that 2007 period. So what happens as we did see the Federal Reserve raise the benchmark interest rate? We see growth and inflation slowly start to taper off until really we get into this financial crisis period with the big recession. And what do we see here during the recessionary period that we had just a few years ago? We see the Fed really kind of lagging behind growth and inflation. So if you take a look at what's happening with growth and inflation, although we see inflation remain fairly high during the 2008 to 2009 period, when we take a look at the green line, which is the growth rate, we see that really drop really at a sharp pace to the downside, really showing some big declines. And in essence, we see the Fed following behind because we see growth and inflation really starting to taper off. The Fed needed to react, and that's why we see the Fed really just chopping away at the benchmark interest rate and ultimately keeping it close to zero till present day. And now what do we see? We see growth really coming to rebound off based off of those rate cuts that we saw off the Federal Reserve. And now we sort of see growth climbing up, same thing, same sort of with inflation, but taking a look at the last growth reading, we saw that rebound a little bit above 4%, but now we'll have to see how things really pan out going forward. And this is why keeping a close eye on these fundamentals is very important. Why? Because this is essentially what the Federal Reserve looks at, and this is what really makes them react on the benchmark interest rate. So beyond this, here we have some arrows here to further clarify my point here. So again, during that period between 2002, again, growth and inflation slowly starting to climb up. What do we have here? Between that 2004 period, again, we see it peak, we see growth and inflation really peak off, starting to come down, and in fact, we see the Federal Reserve act upon that. Next, again, now we see growth and inflation starting to pick back up. So essentially the next move that, based on these numbers that we could anticipate from the Federal Reserve is we should be getting higher interest rate as we see growth and inflation pick up. But again, we'll have to keep a close eye on how growth and inflation really performs going forward to get a better sense of what the Fed will do going forward. So one way to really gauge what the Fed will do is overnight index swaps. And I'm sure for those of you that attended a lot of presentations over the course of the last few days, a lot of us talk about overnight index swaps and essentially what overnight index swaps are, according to this definition from Investopedia. Interest rate swaps involve the overnight rate being exchanged for some fixed interest rate. But for a better definition and for an easier definition, I have actually referred to our Bloomberg terminal, and our definition from Bloomberg basically says it measures the number of basis points of rate hikes or rate cuts that are priced in for a given period of time. So how does this look like? And I'm sure for those of you that have referred to a lot of reports, we actually mentioned this a lot, but taking a look at how Credit Suisse overnight index swaps performs in terms of the real interest rate decision by the Federal Reserve. So here we have basically Credit Suisse overnight index swaps. overlapping on what the Federal Reserve did. So over the last pretty much 4 years, as we did see the interest rate come down during this whole financial crisis period, again, we saw the Fed pretty much bring down the interest rate as close to zero as possible. So what happens, and as we saw with the growth and inflation readings from my previous example here, market participants were really looking for that rate hike, essentially as we did see growth and inflation start to pick up. So when we take a look at what's happening here, as of late, we've seen interest rate expectations really taper off, starting as we head into 2010. Big reasoning why is the Federal Reserve, they're really less confident in this recovery. I'm sure for those of you that have been keeping up with what's been going on in the economy, and we'll break down all these data that the Fed is looking at later on in this presentation. But as we do see interest rate expectations slowly start to decline, what does that mean for the US dollar? Again, higher interest rates means to a stronger dollar, lower interest rates leads to a weaker dollar. And based on this interest rate expectations, because we've been seeing this decline, has really translated into a lot of US dollar weakness, especially over the near term, where essentially we see interest rates or overnight index swaps really just holding at zero. So they don't expect interest rates to be changed over any given period of time, especially over the near term. Going on with this presentation, and again, because you need some kind of service, or what we use here at Dailyfx, we use Bloomberg Professional Services, which really is a heavy cost, especially for retail traders. Here's a key way to really gauge for yourself and a tool for retail traders on what we should expect from the Federal Reserve. And the best gauge that we get ultimately from the Federal Reserve is the policy statement, which also incorporates the economic outlook. So I know I've been getting a lot of questions about a lot of this market terminology, but essentially what is a hawkish bias and what is a dovish bias here? So based on the Fed policy statement, we get a gauge of what they're really looking at, what are their major concerns, what are some upside risks that they see, and based on that, we get a clear sense of, or we get a better sense of what they intend to do going forward. So when they have a hawkish bias, the comments that we really look for is faster growth or upside risk for inflation, and then ultimately suggesting that we could see higher interest rates going forward. So anytime we see the Fed really concerned about too fast of growth rate or higher risk for inflation, we typically label that as a hawkish statement, and essentially what we look for is a bullish US dollar reaction. Vice versa, dovish bias, or this dovish statement that we see from the Fed, we see the Fed really concerned about slower growth or really a low risk for inflation, giving us the idea that ultimately we'll see low interest rates going forward, which tends to be bearish on the US dollar. So again, taking a look at the policy statement, this is kind of what I look for in the policy statement, is really their economic assessment, what they expect for growth, what they expect for inflation. And that gives us a good sense on what to expect in terms of the US dollar, how it could perform going forward. So why is it so important on what the Fed says, and why is it so important about the underlying strength of the economy? And as I mentioned before, fundamentals really help us to gauge the strength of the economy, which should be reflected in the exchange rate. So what is the exchange rate? It's really a rate at which one currency may be converted into another. So what are we looking at here with interest rates are the interest rate differentials. And according to Investopedia, it is basically the gap in interest rates between two similar interest-bearing assets. And we could clearly see that across the global economies, especially when we look at the benchmark interest rate itself. So taking an example here, as I mentioned with the Fed, they've been holding the interest rate close to zero, while compared to one of its major counterparts, such as Australia, we see an benchmark interest rate of 4.75%. So in terms of just basically interest rate differential, when we subtract the US interest rate from the Australian interest rate, we get nearly 4.5% interest rate just on that interest rate differential. And again, this is really a variance in monetary policy, and really it's just a comparative growth based on what's going on in each individual country. So again, the reason why we see Australia have such a high interest rate, it's because the central bank saw a higher risk for inflation, they saw robust growth, so they decided to raise the benchmark interest rate, which we have seen to really help benefit the Australian dollar. So based on all this information here, how can we gauge on what to expect going forward? And one resource that ultimately I like to look at, and of course this is all available to retail traders, is from the International Monetary Fund. And one table that I always like to look at is the International Monetary Fund's growth forecast. So we have a table here really just breaking down what actually the International Monetary Fund expects to see. They give us their projections on what they expect over the course of the year and even into the following year. So breaking down that table, and again, these slides will be uploaded, so if you want a better look at the table, you could actually even go to the IMF's website, and it's all available for you. But breaking down what happens, so again, because we're looking at the strength for different currencies here, one thing we're looking for is comparative global growth. So in 2011, according to the IMF's projection, what do we see? The advanced economies are actually expected to grow a collective 2.2%. When we take a look at the breakdown, though, we see that U.S. leads its major counterparts. As we see, the U.S. is expected to grow an annualized 2.5%, followed by the Eurozone at 2.0%, while the U.K. tipping in last at 1.5%. So based on this comparative growth that we see, based on the IMF data, we see the U.S. leading the economies, or the major industrialized economies, or the category advanced economies that the IMF has placed these three major countries. So what do we expect for 2012? Again, advanced economies are expected to grow a little bit faster. They have a collective growth rate of 2.6%, but one theme that we see here is basically Eurozone and the UK continues to lag behind. So US 2.7%, Eurozone 1.7%, but UK slightly faster at 2.3%. So what does this suggest to us? And again, the way I like to use fundamentals is more of a long-term approach where in the long term, we should see the US dollar come back or really outperform against at least the euro and the British pound in terms of relative growth with one another. Beyond this, we come to growth. So what is growth and what is gross domestic product? And I actually broke down the formula here. What all these components stand for is GDP, which is gross domestic product, is equal to consumption, investments, government spending, and net exports. So here's the basic formula here. Anyone that's taken a very basic economics class has pretty much seen this. So we'll break down this GDP data going forward. So here's another table that I like to look at, and of course you could all find this on the Bureau of Economic Analysis website here. And again, looking at this first table, and this is actually for the US economy, it can be very tedious. So I want to show everyone how to kind of take a look at this gauge. And I mentioned before, private sector consumption is one of the fastest or one of the biggest drivers of growth in the UK economy, and this is clearly reflected in this table here. So we'll take a look at breakdown of this information here. So again, when we take a look at personal consumption expenditures, which is basically private sector spending, we see that based on the other numbers here, which are going to be shown up here, here we have gross private domestic investments, business investments. Compared to all these data here we have net exports, again, part of that formula, followed by government expenditures or government spending. We could clearly see that private sector consumption accounts for most of the economy that we have based on this Bureau of Economic Analysis table. Clearly by this, what are the important factors that the Fed is looking at? Because private sector consumption is one major component of the economy, we're really looking at households such as me and you, and what the Fed really wants to do, and that's why one of their primary mandates is full employment, is due to the fact that this is how our economy is made up, where private sector consumption really accounts, or is really one of the major pieces of our economy here. So beyond this, again, private sector consumption, one of the biggest leading drivers of growth here. And we'll take a look at some of the gauges for private sector consumption. And pretty much throughout my presentation here, I'm giving everyone here a way that you could go home, go to these free websites, do your own homework there. And again, we'll look at some of the data that I've came across and pretty much what I expect to see going forward. So private sector consumption, essentially household spending. So what pieces of data do I look at? One piece of data I really like to look at is retail sales, which is actually released by the Commerce Department. And again, all this data can be found on our website. At the same time, I look at orders for U.S. durable goods. And what are durable goods? Durable goods are really just large ticket items that last for typically more than 3 years. So such as a car or a washing machine. These big ticket items where we can't really just go and buy it on an everyday basis. We actually save up for that, and we like to purchase these big ticket items that typically last for a few years. But beyond that, another gauge that I like to look at, which is sort of forward-looking, because again, retail sales data, or really the orders for durable goods, we only get that in the following month. So since we're in September, we'll only see the September reading when we get to the month of October. Again, these are really lagging indicators. So what gives me a good gauge for a more forward-looking projection and essentially giving us a better gauge of what to expect going forward is consumer sentiment. And how I like to look at that is based on the U of Michigan Consumer Confidence Index, as well as the Conference Board's Consumer Confidence Index as well. So taking a look at the breakdown of this data, which will come up in a short minute, in the next slide, we also want to look at business investments. Again, these are more of the private sector data that I like to look at. And again, business investment comes up. And besides business investments, and really what I like to look at here is output. Basically, manufacturing versus service-based activity. And again, I like to refer to the Institute of Supply Management. And beyond that, we also get a gauge of what's going on in terms of inventory. So we'll take a look at all this data right now. So here we have household spending. And here we have U.S. retail sales tacked on a chart with U.S. durable goods. Again, both gauges of how households are spending their money and whether they're spending, and really what, really the general trend behind private sector consumption. So when we take a look at the recent data here, what do we see? It's been relatively flat. You know, we see some spikes up, some spikes down, but when we take a normal, or when we take a look at pretty much what's been happening just over the last year and a half, it's been relatively flat after we came out of this really recession that we had. So beyond that, we want to look at consumer sentiment. Again, giving us a more forward-looking projection for household spending. What do we see here? During that recession period, we saw consumer confidence really tail off, really falling at a rapid pace. And now what do we see? Sort of rebounding. Give us a good sense that, you know what, maybe consumers are feeling better about the economy. And in turn, we might see a faster pace of household consumption going forward. So based on the data that we have, so based on the retail sales data, based on the U.S. durable goods orders, we've seen flat growth, but taking a look at the consumer sentiment in next year, again, the U of Michigan and the Conference Board's survey, it suggests to us that over the near term, we might see things start to improve going forward. Beyond that, again, we'll look at business outputs here. We saw a big decline during the recession, and now it looks appear that we were in an upward trend, but really topping off right now, especially over the course of this year. So what does this mean to us? That essentially consumers could be increasing their rate of growth, while businesses are really starting to slow back, cut back on production here. And again, this is the ISM manufacturing, as well as the USM, or the ISM US non-manufacturing in the indices that I plotted on this chart. So taking a look at the indices here, again, this is the US manufacturing inventories as well as the US wholesale inventories. So getting a gauge of really just private sector as well as wholesale or retail versus wholesale. One general trend that we could see here, and again, similar across pretty much all the indicators that we've been watching here, is there's that decline, and now we're seeing things start to bounce back. But again, it looks as though we might have peaked. Things are starting to flattening out, and that really seems to be the big story here. Beyond that, what we want to look at is employment again. One of the Fed's mandate is full employment. So what data do we look at is the Labor Department's non-farm payrolls. I'm sure for those of you that joined us for this webinar that we always hold on non-farm payrolls, typically one of the biggest market movers that we typically see, not only for the FX market, but for the financial market as a whole. And what do we get from this non-farm payrolls report? We essentially get a gauge of public and private sector employment. Beyond that, we also get the employment rate, the rate at which we typically like to gauge as how many people are unemployed in terms of the whole population. And beyond that, we get a labor pool. So a gauge of really the workforce. So how many people are really looking for work, how many people are not, and really out of this whole population that we have in the United States, what is really the labor force that we're looking for. So taking a look at what's been going on with pretty much the labor market as a whole, and I'm sure a lot of you have been hearing a lot about this, especially once just during the last few days we did get that speech from President Barack Obama trying to really help the labor market here, it's really been a sad story what's been happening during the recession. We nearly lost 8 million jobs during this recession, slowly starting to come back from that. But again, taking a look at here, we saw non-farm payrolls, which acts as a gauge for employment, has steadily increased, while unemployment has started to decrease. But again, not really anything major here. We saw that big pop coming off of that recession period, but really nothing spectacular. Everything's really starting to taper off here. Beyond this, we also want to look at inflation. Again, that mandate of price stability. So, consumer prices. What we like to look at is, and there's two different types of inflation that I like to look at, is demand pull inflation, which is technically the inflation that we like to see. Basically, this demand pull inflation comes off of a faster rate of consumption. So, based on this, the assumption here is rising demands, we have rising demands and falling unemployment. And because we have such robust growth, people are able to charge more because there's a greater demand for pretty much everything across the board. So what do businesses do? As supplies dwindle, because we are seeing such a rapid growth in demands, they actually start to charge more to slow those demands. On the other hand, what do we have here is cost push inflation. And as I mentioned with my gas prices, my experience with gas prices as of late, that's actually what we're experiencing now, where we do see lower supplies. So the assumption here is there's really no alternative to the product that we're looking for. Essentially the same thing with gas. And we see prices rise as goods and services turn scarce. So essentially what's happening with, let's just take oil for example. We're having a lot of growth in a lot of these emerging economies. That's been a lot of the reasoning, or really from the Federal Reserve, what we've been hearing is that demand from a lot of these emerging economies has lowered the supply of crude oil as well as gas. And really, there's no alternative to these, and that's why we have seen those higher prices for gas. So, what do we look for? Is the Consumer Price Index, which is actually released by the Labor Department. And again, all this data can be found on their website. So, what do we look at? We look at the annualized consumer price index, which really is the headline reading for inflation. The reason why we look at the consumer price index rather than some of the other gauges for inflation is because this is what a lot of the policymakers look at, and this is really what they base their decision on. So, here's a breakdown of what we get, essentially, is we get energy and transportation costs, food and beverage costs, costs for housing, for services, apparel, education, medical, and recreational. So, giving us a good sense. And why is this so important? Because again, private sector consumption is one of the main drivers of growth in our economy. So these are the things that are really affecting our decisions on a day-by-day basis on how we would like to spend our money. But beyond this, another thing that the Fed really likes to look at is the core rate of inflation, which excludes volatile prices for food and energy. And I'm sure everyone could really relate to this, especially when it comes to energy. And at the same time, with food, we see similar things. When supplies are dwindling, we see higher prices. So we also like to look at the core rate of inflation to really get a better gauge for all the other categories that we have listed here, such as housing, apparel, education, medical, and recreational. So plotting this on our chart here, what do we see? So as I mentioned before, and throughout the numerous examples that we saw today, during that recession period, we saw inflation come steadily down. Really, we see it more volatile in the core, in the headline reading for inflation, which is actually the red line here, but in the blue line, which again strips out those volatile measures for food as well as energy, we see it really coming down slowly on a relatively slowing pace. But now what do we see here? Especially over the course of this year, or coming into 2011, we see not only is the headline reading for inflation increasing, we're also seeing the core rate of inflation increasing as well, really showing or really reflecting that we could see possibly inflation continue to push higher over the near term. So, based on all this, what are we really looking for with a lot of these economic developments? Again, main story behind fundamental analysis is the strength of the economy should reflect the exchange rate, and really we want to know what policymakers are looking at. So, central bank policy is to balance the risk for the economy, basically growth and inflation. When we take a look at what the Fed has to do is they want to promote good growth. Again, they don't want growth to be too fast where it stokes a lot of inflation, but again, they want to balance the two where we have a good rate of, or actually a rate of inflation that helps to promote full growth, but at the same time, we don't want to get inflation too high where it dampens citizens' ability to buy the necessities that they need in life and really helping to, or really dampening the outlook for future growth as well. So, based on these economic developments, it could really spur a shift in monetary policy, and I'll go into some of my outlook at this time right now. So, based on the recent things that we heard from the Federal Reserve, they're really concerned about unemployment. Not only have we heard about that from the Federal Reserve, but from President Obama, we've been hearing that is a major focus in the economy right now. And what has happened to the risk for inflation? The Fed has really pushed that to the back burner, not showing too many concerns. Really, they're saying a lot of these temporary factors, such as high energy prices, high food prices, really what's been spurring inflation. So what is the Fed really focused on right now? And why they're really keeping that benchmark interest rate close to zero? Is because they're really worried about the economy. Namely, they're worried about how private sector consumption will perform going forward. Because again, if we have low unemployment, if people are out of jobs, they don't necessarily have the resources to buy, thereby stimulating the economy. And this is what has really been the main focus of the Federal Reserve, and it continues to do so, especially for those of you that were able to watch the last Fed interest rate decision. We heard some surprising news. Fed wants to keep the benchmark interest rate close to zero until middle of 2013, which is, it blew my mind when I really heard that come through the wires. I thought we weren't going to get anything close to that. But again, we did see the market react based on that. One very interesting thing about that Fed interest rate decision, when we take a look at what they really did, is they really haven't done anything to monetary policy. They haven't done more quantitative easing. They didn't decide to expand their balance sheets further. But again, because we're looking at what the Federal Reserve is looking at, we're trying to get a gauge of what they're really concerned about. Because they're so concerned that they feel the need that they might have to do that, we saw a big market reaction to that, thereby taking a lot of confidence out of the US dollar, and we've certainly seen that reflected in, or we've pretty much seen that reflected in a lot of the US price action as of late. So, beyond that, what do we look for is changes in interest rate expectations could foreshadow future movements in the exchange rate. So as I showed with our first example with Credit Suisse overnight index swaps, interest rate expectations have tapered off, and as we keep a close eye on the Fed's rhetoric, we continue to see that we won't see higher interest rates anytime soon. Again, that pledge that we got from the Fed, middle of 2013, that's when they expect to keep, or until then, that's when we'll see zero interest rate interest rates, has really dampened the outlook for rate hikes as well. Personally, for me, I thought maybe we could see a rate hike towards the middle of 2012, but it seems as though I'll have to push back my forecast for that, and it really seems as though that might pan out. And really, one thing I'm really focused on, especially over the coming days, is the next federal interest rate decision on September 21st. And again, there's a lot of speculation surrounding this, and really, I wouldn't be too surprised if we do see a big reaction to that. There's a lot of eyes watching what the Fed will do next. So in terms of all the stuff that we've seen today, to briefly go over again, this recovery that we had in the US following this recession, taking a look at the recent batch of data, we did see a good rebound after the Fed took all these extraordinary measures to stimulate the economy. But what we see now is growth is really starting to taper off. Big reason why is because of the high employment rate. And that's why the Fed is really trying to target that. And again, they're coming with very innovative ways to stimulate the economy. But again, until we do see the unemployment rate come down, until we see that robust rate of growth, we probably won't see the Fed move on interest rates anytime soon. But that's pretty much my outlook. And right now we'll get into some more things. So, comparative growth. What do we expect? U.S. is still supposed to outperform the Eurozone and the UK. So, growth to slowly get the pace, and that should lead to inflation to accelerate. So, again, what the Fed is trying to do is really start to stimulate growth. But what are we seeing with inflation? Inflation is really picking up. And again, because it's a balancing act for the Fed, the immediate concern right now is to stimulate growth. But once we do see that growth pick up, we'll see the Fed switch their outlook, turn their attention to inflation, and ultimately they might try to bring that down, thereby raising the benchmark interest rate. So, Fed has told us they'll look to keep the benchmark interest rate on hold until 2013, but we'll have to see whether that really becomes the case. So, what are we looking for when we do expect, or when we do see growth pick up, when we do expect inflation to pick up even further, look for that hawkish statement from the Fed. That should really give us a great clue on what to expect in terms of how the US dollar should perform against its major counterparts. So, again, there's all the speculation that ultimately we might see the Fed look to expand its balance sheets further, conduct additional quantitative easing, but ultimately, once we do see the Fed conclude their easing cycle, the only next possible move that we have from the Fed is to start normalizing monetary policy. So again, once we do see that hawkish rhetoric coming out of the Fed, one thing we can expect is interest rate expectations will gradually increase. But until then, we'll have to really just wait and see what the Fed will tell us. But beyond that, once we do see all these things come into play, expectations for higher inflation, higher growth, as well as interest rate expectations picking up, we should probably see some increased demand for the US dollar because, again, why? We expect that higher federal funds interest rate, thereby increasing demands for the US dollar. So, again, a lot of the tools that we went over today, I wanted to give retail traders here a tool where you could go home, go to these websites, look at the data for yourself, make your own assessment. Because, again, we're looking through all these numbers today, and these are, again, my own expectations and what I interpret from this piece of data. But again, I encourage everyone here to do your own homework. It's very important to get a gauge and really keep these things in the back of your mind. So again, going back to my example of how I look at fundamental analysis, it should be our broader outlook on what to expect over the long run, medium to long run. But technicals, those are the tools that I like to use more on the short term. But again, we cannot ignore the fundamentals. Why? Because my belief is the strength of the economy should be reflected in the exchange rate. So that's pretty much my presentation for today. I hope everyone got something out of today's presentation. And again, for those that want a copy of the slide, we should have it up on fxcmexpo.com shortly. But again, in this presentation, I definitely put out a lot of where the data comes out. So hopefully some of you will go home, maybe go on the Labor Department's website, take a look at their data, because there's a lot of information out there that retail traders like us can really just use at home. So I hope some of you got there, but we'll get to some questions now, and I'll just leave this risk disclaimer up. I really hope everyone enjoyed their time here, and just want to thank everyone for joining me today, and hope everyone has a safe trip back home.